And we are live again. So, as you can see there on your screen, we've already got another person at the Federal Reserve. This time it's the Boston Federal Reserve Bank President. The guy's name is Rosengren, Eric Rosengren. Thought initially when I saw this article that it was Barry Eichengreen. I guess I get the names mixed up. I think he's the key Keynesian academic, I think at University of California, Berkeley. But this article should not surprise you if you are a longtime listener of my Wall Street from Main Street YouTube channel. If you are a new listener to my Wall Street from Main Street YouTube channel, if you're one of the 100 new subscribers that has been added in the last 6 weeks thanks to YouTube censorship, let me catch you up to date on how things roll and my rule number 1. So, this is the most important rule. Rule number 1. I've been talking about this for years. I have studied financial history. My initial background was in history, one of my 2 college degrees, history and political science, and then I added all these other skills with business and real economics and entrepreneurship and investing. Those things were all added through very, very hard work, reading over 500 books, thousands of articles, over 100 documentaries, enormous amounts of audiobooks, podcasts, and things like interviewing over 500 experts in the archives of my YouTube channel later. So I am a student of history, and from going back through history, studying empires like the Roman Empire, where the last couple hundred years of the western part of the Roman Empire, not the eastern part with Constantinople, but the western part, hundreds of years before the Roman Empire ended, there was a crazy amount of rules changes. Laws were changed, rules were changed. It was insane how many rules were changed. Okay, go back and study history. This happens towards the end of governments, the end of large empires. So, rule number 1 of the 3 most important rules of investing in this quote-unquote new normal. I wrote this, I think, 6 or 7 years ago. Okay, rule number 1, politicians and governments can and will change the rules anytime they want, perhaps on a daily basis, which is moving the goalposts, retroactive rules, moving the targets, if they do not get the desired outcomes that they want. And this is what the Federal Reserve Bank is already talking about doing. Because if you talk to the stuffy shirts, the mainstream financial professionals on Wall Street, they will tell you, and my friend Christopher Irons at QTR Podcast, they will tell you they will give you some stupid speech like, technically the Fed is not allowed to buy stock. Technically the Fed is not allowed to do any of this. The rules have to change. So you're a tinfoil hat conspiracy theorist if you think the Fed is buying S&P 500 E-mini futures at 3:08 p.m. here on the charts. Oh, excuse me. Wait, yeah, 3:08. Yeah, 3:08 p.m. where the Dow Jones Industrial Average at 3:08 p.m. Eastern Time yesterday on March 6th magically had an enormous rally starting then. You look at the charts there, the charts are not looking good, and then magically there's a not-for-profit rally, just enormous there. There was another manipulation rally attempt at 9:53 a.m. The rally did last for a little while, and then it started going down again. And we had the exact same BS bullshit start last week. There was at 3:44 p.m. Eastern Time. That was an even larger manipulation rally. But the mainstream people, the mainstream financial media, the mainstream financial professionals, the Fed's not allowed to do that, and the Fed follows the rules. Blah, 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 blah. Okay, when have people in power actually followed the rules? I've lived here in the Washington, D.C. metro area, and I've met countless amounts of government bureaucrats and others here in the federal government who think they're above the law. That's for the regular people. That's for the serfs to follow the law. The people who implement the law, they don't have to follow the law. They only follow the law when it's convenient. That's the truth. So, rules changes. Rule number 1 is rules changes. The rules will change. And this is what Eric Rosengren, the Federal Reserve Bank president, the Boston Federal Reserve Bank president, is proposing. He said policymakers should be allowed to buy a broader range of assets, so he wants legal cover. However, my guess, plunge protection team, multiple plunge protection team, exchange stabilization fund, Federal Reserve is already doing this. They just want the legal cover now. They want it legally allowed so they can do even more of it. Because it's not working. because they know that professional money managers, the comments are coming out. Bill Ackman just made comments that he's hedging. He disclosed he's not selling all his stocks, but he's hedging. He's worried about a stock market crash. There was another article that just came out yesterday from this Alliance Global Investors portfolio manager, Mike Riddell, who oversees $4.7 billion. The speed of the stock market repricing, which is a crash, has obviously been dramatic. However, markets have only gone from pricing in no risk of anything to a moderate risk, and he thinks markets can still get a lot worse and more volatile. And he thinks potentially high risk of a stock market crash. So he's been a top portfolio manager lately, beating 98% of his peers. If you want to read that interview, it'll be in the information and description section. So the Fed knows that lots of professional money managers do not trust the CDC, do not trust the Trump administration, do not trust President Trump to properly navigate the U.S. economy and Americans through this cerveza problem that all the news stories are just getting worse. Also, another news story out from excellent, superb investigative journalism from Caixin Global, talking about how there is no recovery in China from the cerveza problem. No recovery whatsoever. If you want to read that article, maybe I'll do another short video on that one. I think most of that article is behind the paywall. It goes more into depth about how factory owners are being told, even if there's no factory workers, to still run the factory equipment to show that electricity is being used, and other nonsense. So the article interviews whistleblowers, people inside China. Bottom line, though, is that the Fed wants legal cover now, which means they have to get congressional approval. They want legal cover to go and buy more assets, because asset prices falling does not work when the system is over leveraged. That makes the entire system even more insolvent than it already is, with asset prices falling. Okay, so Federal Reserve Bank of Boston, I'll just read the article now. Federal Reserve Bank of Boston President Eric Rosengren said policymakers should be allowed to buy a broader range of assets if they lack sufficient ammunition to fight off a recession, while with interest rate cuts and bond purchases. With 10-year U.S. Treasury yields notes already at record lows, Rosengren said typical quantitative easing may not work to move asset prices higher. I'll add that, as it did during the 2008 financial crisis. Yes, because you have professional money managers now who are selling every rally. Okay, go and look at the tweets of Dr. Ben Hunt of Epsilon Theory. If you are not familiar with him, go and watch his interview on Real Vision TV. It might actually be free now on their YouTube channel. He has an enormous mansion, I think, in Connecticut. It's unbelievably large. And Grant Williams went there to interview him. He used to manage money professionally at hedge funds, and he is friends with a lot of the top hedge fund managers. And he put out a tweet in the last week or so that 90% of the professional money managers he's talked to who manage many billions of dollars, 90% of them do not trust President Trump and the Trump administration and the CDC to properly manage the cerveza problem here in the U.S., and that they are selling large blocks of stock. They're not dumping it all at once necessarily, but they're fading every rally, every potentially not-for-profit manipulation rally. So when you have this happening, the Fed has to change the rules, because professional money managers are dumping stock, and the Fed does not want stock prices going down. Okay, back to the article. Rosengren said typical quantitative easing may not work as it did during the 2008 financial crisis. Therefore, the Fed may need the flexibility enjoyed by policymakers in Europe and Japan. Here we go. Quote, "We should allow the central bank to purchase a broader range of securities or assets," Rosengren said in a speech Friday in New York. Such a policy, however, would require a change in the Federal Reserve Act. They want legal cover. Okay, wink, wink, nod, nod. Do you really think, I'm going to put on my tinfoil hat conspiracy fact, financial journalist hat here. Do you really think that they haven't been buying other assets? The charts have been painted. The S&P E-mini futures contract, S&P 500 E-mini futures contracts. There's been really strange activity in those for years. I've talked with hedge fund traders. I've talked with professional money managers about this. And, they look at the chart and the last 30 minutes sometimes before market close, or sometimes even 10 minutes before the market closes, in the late afternoon Eastern time, there'll be an enormous amount of buying of those futures contracts. very not for profit, because a professional trader would not come in and buy $10 million worth of S&P 500 up to, I've seen $10 million orders in a very short amount of time, literally in a minute. S&P 500 E-mini futures contracts in a minute, $10 million worth, and other large purchases. Again, painting the tape to make sure that the markets do not close at lower and lower levels, to bring the losses back to almost even. This is the new normal, folks. But this, getting the rules changed in the Federal Reserve Act, would give the Federal Reserve more legal cover to do whatever it wants. U.S. law currently limits Fed purchases to, quote, any obligation, which is a direct obligation of, or fully guaranteed as to principal and interest by any agency of the United States. I just want to do a goofy voice there. That translates to buying U.S. government and agency debt and mortgages issued by federal housing agencies. The Fed has traditionally maintained a strong internal resistance to expanding its purchases. Those of you in the gold and silver community don't agree with that. To expanding its purchases beyond Treasury securities, because such activities are essentially credit allocation and leave the central bank vulnerable to criticism of favoritism if it's investing in the bonds or stocks of specific companies. Just like how the Bank of Japan's central bank now owns, I think, 80% of all Japanese stock market exchange traded funds. That is freaking insane. And between the Bank of Japan Central Bank, and the couple largest Japanese pension funds and the Japanese banks, they own basically all of the Japanese government bond market. So there are some days where the Japanese government bonds don't even trade at all. There's almost no volume. Quote, New Deal progressives are not going to tolerate this unless the unemployment rate has risen sharply, said Mark Spindle, a co-author of a book about Congress and the Fed. During the financial crisis, the Fed bought agency-backed mortgage-backed securities to bail out hedge funds and the large U.S. banks. I added that part. The article just says to help revive markets for housing debt. Okay, it was really a secret bailout of the hedge funds that were owning that garbage and the Wall Street banks that had too much of it and were stuck in the game of musical chairs and hot potato. The game ended and they were stuck with this toxic sausage mortgage-backed securities that they couldn't offload. So they offloaded it to the Fed, who paid 100 cents on the dollar, when in reality these subprime mortgage-backed securities were probably worth less than 10 cents on the dollar, if that. As of March 4th, the Fed held $1.37 trillion in mortgage-backed securities. Fed cut. Rosengren's remarks came as yields on 10-year U.S. Treasury notes plunged to as low as 0.66% on concern the spreading virus would dent the world's largest economy. The Fed lowered its benchmark policy rate by 50 basis points in an emergency move Tuesday to a 1% to 1.25% range, with investors betting it will cut by a further half percentage point by the end of this month. Rosengren's not a voter this year on the rate-setting Federal Open Market Committee. Also, let me add that they want these rules changes in spite of the absolutely excellent work that hedge fund manager Tavi Costa of Crescott Capital has put out with his charts. He just put out another chart yesterday, I believe, showing that the 5 or 6 largest central banks all over the globe in only the last 20 days have increased their balance sheets an extra $625 billion, and in spite of this increase of $625 billion in balance sheet increases, the markets, the stock markets, commodity markets are still collapsing. You also have the Saudis now, who, despite these OPEC production cuts that they did, the Saudis seem to have reversed course, and the statement just came out in the last 24 hours now. Maybe it was trading on inside information prior to that this week, because you have oil stocks absolutely collapsing yesterday. You have some of these oil stocks like Diamond Offshore Drilling, which things look dire there now too. That stock, even though oil prices dropped 10% yesterday, Diamond Offshore dropped 21% in a single day. I'm not even sure that happened in 2008. Trying to think if that did. I don't think it did. Things were bad in 2008, but I don't think they dropped 21% in a single day. So the deepwater offshore drilling companies, things look very dire. The market is starting to price in very high bankruptcy risk, not for one of these deepwater offshore drilling companies, but for all of these deepwater offshore drilling companies in the next 12 months, unless there is an unbelievably good oil price rally and turnaround. But with the new Saudi strategy that just came out, it seems the Saudis want to increase oil production and put the final nail in the coffin for U.S. shale oil producers, because the Saudis know if they increase oil production and they take oil prices just a little bit lower, that the higher cost shale oil companies, either they get bailouts or they go bust. So in spite of this crazy amounts of central bank intervention in the last 20 days, balance sheet expansion, the stock markets, professional money managers are still not interested in being long stocks right now. And that's why the Fed wants to change the rules. I've been talking for a long time that eventually we would get to this crisis scenario here where the central bankers would run out of a lot of the ideas that were working for them, and they'd say, you know what, nothing else is working, we have to keep changing the rules. It looks like we've gotten to that point now. Quote, if the economic reaction to the cerveza problem does result in the funds rate falling to its effective lower bound, this heightened sensitivity of the 10-year US Treasury rate to adverse news raises the possibility that the 10-year US Treasury rate could follow close behind. Rosengren said, that would be little room for the Federal Reserve to lower rates through large purchases of long-term Treasury securities. The comments come as the Fed is in the middle of a review of its policy tools and strategy, a process that has been somewhat overwhelmed by the sudden and stunning loss of policy space as longer-term yields decline and traders forecast another half-point cut at the March 17th to 18th meeting. Rosengren said that if the Fed was permitted to broaden the scope of assets it buys, the U.S. Treasury should indemnify it against losses, while noting that fiscal policy should also... But central banks don't have to mark to market, so central banks technically can't be insolvent. The U.S. Treasury should indemnify it against losses. That's interesting. Why would the Federal Reserve need to be indemnified against losses when they don't have to mark any losses to market? That's interesting. While noting that the fiscal policy should also shoulder a greater burden with interest rates already low. Okay, I need a water break. He also resurrected the idea of establishing a facility that could buy broader assets provided that Treasury insured the central bank against risk. During the financial crisis, the Fed invoked quote, unusual and exigent circumstances to create funds that bought assets from failing financial institutions. The bailout move was controversial with lawmakers. All of these ideas point sharply to the fact that central bankers realize they are running out of room at a time when very few ideas have come out of the Trump administration to cushion the economy from the cerveza problem disruptions. You can't blame all of this on the Trump administration. The global supply chain is a mess long before Trump won in 2016. And you know what? Even with the tariffs that Trump was putting against China, very few companies actually started switching over their supply chains out of China. Welcome to Dystopia. Okay, so let me take a look at the super chat questions. Looks like I got a lot of them. JB Weld, thank you for the super chat. Thoughts on smaller cap midstream oil companies, new subscriber. I have been warning people for over 8 months about being long any oil stocks because the Chinese, this was before the cerveza problem in China, that the Chinese economy was much worse than their official data was suggesting. And so the demand side on oil was going to slow down, and shale oil production was still increasing back then at 1.7 million barrels per day out of the Permian Basin. So there was price-insensitive oil production growth, and demand was weakening. You could see that with car sales falling. So I've been telling people for over 8 months, and I've been getting really nasty emails, really nasty comments below my oil videos from a lot of people in the oil industry, from the shale patch, telling me I was wrong, I didn't know what I was talking about. The U.S. economy was going to do great because of cheap oil. And looks like I called this perfectly. I doubt I get any credit for it, but I was warning people. You were warned over 8 months ago not to be long oil companies. I still get all these emails from people sending me like 10 pages worth of oil stocks that they bought and just trying to justify why they were buying the dips in oil and telling me how much smarter and richer Keith McCullough hedge I was, and I didn't know what I was talking about, even though my day job was an oil analyst for a year, and I worked with one of the best oil analyst out there who has a very successful $500 a year paid investment newsletter, Robert Rapier, 30 years of experience working in the oil and energy industries. I was mentored by him interviewed him many times too, interviewed many other oil experts as well, told that I didn't know what I was talking about. Warned people about the oil. I would not be long any oil companies, JB Weld, right now, because you know what? If the Saudis are going to increase oil production now, despite the oil prices that the prices we're at, the Saudis do not care. The Saudis are willing to take losses. The Saudis did this. For the last time I can remember the Saudis did this, they tried to kill shale in 2013, 14, and part of 15. They tried to do it for a couple years, and they dipped a lot into their sovereign wealth fund, and they refused to cut, OPEC and the Saudis refused to cut oil production back then, and they were under the assumption back then that shale oil's production costs were around $65 a barrel, and they couldn't cut costs anymore. And so the Saudis refused to cut oil production, and they thought for sure back then that they would bankrupt the shale oil producers then, and they were wrong. So the shale oil producers were able to raise more capital, sucker more pension funds. The Wall Street banks hooked them up. Private equity was able to find suckers with junk bond debt because of financial repression, and the shale oil companies were able to cut their costs somewhat, although not make a lot of free cash flow. But I think this time is different with the shale oil companies, and the main reason why this time is different with the shale oil companies is there's not as much sucker money available. So the pension funds, hopefully, have wised up, and the pension funds are no longer willing to invest in these unprofitable, no free cash flow generating, price insensitive, oil production increasing shale oil unicorns. So shale's time is ticking. The Saudis, the news story that just came out is the Saudis are actually increasing production now after announcing oil price production cuts earlier this week that did not work. The oil price dropped instead. So the Saudis have now done a 180 and reverse course, and the Saudis are going for the last kill shot, the nail in the coffin. The Saudis are trying to kill all the shale oil companies, all the high-cost oil producers. The Saudis are going for it. That would be my educated guess what's happening, and I would not be long any oil stocks. I expect a lot of price volatility in oil. There may be 5% or more moves per day now in just the oil price. Oil stocks, the volatility could be a lot more than that. If you are an options trader, you can hedge with long straddles, volatility trades with puts and calls. There's going to be a lot of volatility in oil. Ultimately, though, if deepwater offshore drillers do go bankrupt and a lot of shale oil producers do go bankrupt, we're going to see 5 years from now, maybe less, way over $100 a barrel oil with that supply destruction. Once, things are solved with the cerveza problem all over the globe, eventually things will get back to relatively new normal a couple years from now, maybe. There will be economic activity. Maybe 18 months, maybe 2 years, who knows. But yeah, I would not be long any oil stocks right now. Now, in the past, oil refining companies did do well. The oil refiners, so your Valeros, your Phillips 66s, your, Holly Energy. I think those are the three main refiners here in the U.S. So in the past, those guys have done well when oil prices are falling. I'm not so sure that happens this time. We'll see. American Expat says, you forget those orders come in not only large quantity, but way above spot price in order to paint the tape. Yeah, I don't have to go into all the exact details to know that it's a not-for-profit trader to paint the tape. Okay, thank you for the super chat, Dimitri. Dimitri, why aren't you a Patreon account contributor? $5 a month, buddy. You come in here and you spend a lot on super chats. YouTube takes more than, I think, half of it. You can get a lot more value for $5 a month behind the Patreon account paywall. There's a lot of content behind the paywall there. People were warned 3 weeks ago not to be... There was an extra warning, another warning 3 weeks ago, not to be long any oil stocks. Things were going to get a lot worse. Particularly the deepwater offshore companies, which they've totally collapsed. I hope I'm wrong about this, but I think we're looking at industry-wide bankruptcies. I think Seadrill probably goes first. Not looking good for Diamond Offshore. I was looking at Diamond Offshore's SEC filings from February. Oh my God, the stuff that was disclosed in there. They have their cash flow negative. They're cash flow negative, and they're spending. They've taken the credit cards out. So they're worried about not having any working capital about a year from now, and they're going to start massively using their revolving credit facilities, which is, if you're a regular person on Main Street, that's when you're having financial problems and you just pull out 2 credit cards and you just max them out, hoping that you can turn things around and barely make the payments on the credit cards before you have to declare bankruptcy. Okay, so back to your super chat question. Can't they just use Cerveza problem for a few days or weeks of things get out of control? What do I look for as a sign of ETF failure? It depends on the ETF. I don't know which ETFs you're talking about, Dimitri. Are you in leveraged ETFs? Which ETFs are you talking about? Okay, got another super chat from Ace1. Thank you. Economy goes down, somebody sneezed the wrong way. No, it's a lot worse than that. The global supply chain is an enormous mess. Even before China's Cerveza problem, with the Trump increasing the tariffs on China, these global corporations were supposed to start moving their factories out of China, and they didn't do it. Okay, here, I see more. Oh, Dimitri says he's a Patreon account contributor. Okay, thank you. Okay, you're wondering any ETFs in mass? I don't know if all ETFs are going to shut down. It's tough to say. What, the gold mining ETFs? There's more capital in the gold mining ETFs. The miners are not getting the capital. So I don't know if I see the gold mining ETFs shutting down. It depends. Look, if you don't want to risk it, you can set up hedges. There's hedged trades you can set up in that event. If you're worried about ETF shutting down, there's hedge trades you can set up. We can talk more about that behind the paywall on Patreon in messages. Or you could go more extreme risk off. You can go to more cash. A lot of professional money managers are buying puts. They're hedging. And we have extreme risk off, which is more cash, more treasuries. Look at what's happened with all the treasury yields. I was going to do a short video with charts in the next, hopefully, day or two. I have the slide deck just about done. Okay, Dimitri asked, can't they just shut down the markets if they go sour using Cerveza as an excuse? I don't know if they can. They could shut down the markets for maybe a couple days or a week. I don't think that they can shut down the markets for any more than that. This is why the Fed wants rules changes. The Fed wants rules changes so they can move the stock markets up. They want the stock markets to go up. They need. Look, if they shut down the stock markets, Dimitri, there's no capital gains tax revenues for the government. Again, almost everything boils back down to tax revenues. If they shut down the stock market, would you be willing to pay capital gains tax revenues on your stocks? I wouldn't. No, they need this game to continue. They need the markets to not crash. The people in power, the governments need asset prices higher so the system doesn't look any more insolvent than it already is. If asset prices are down, there's two main bad things. So if asset prices collapse, the overall system, financial system, looks even more insolvent than it already is because of the leverage and the derivatives. So you have margin calls, you have counterparty risk, you have other parties that are not insolvent. The other thing is capital gains tax revenues. falling asset prices, most people who have capital gains taxes are long stocks. All the retail investors, all the large pools of capital, and that means then the government tax revenue will have a hole in the treasury budget. And if you look at how much the capital gains tax revenues collapsed in 2008, they collapsed by $1 trillion. I covered this in the video in the archives from last year. Go and look it up if you're not familiar, if you're new to the channel or you forget the video. How quickly is the U.S. national debt growing? I specifically covered the tax revenues that the U.S. Treasury was bringing in for about $2 trillion every year. And the national debt was growing at over $1 trillion officially. It's more than that unofficially. But in 2008, the capital gains tax revenues dropped by $1 trillion, which means then the Federal Reserve would have to come in and fill in the gaps. So the Federal Reserve would have to come in and increase the amount of not QE or whatever the hell they're going to call it. I don't know what they're going to call it now. Not QE, protecting asset prices, protecting Americans' retirement, I don't know. Okay, so we're over 30 minutes. I think I've covered pretty much everything that I wanted to cover in this live stream show. Gold is going to do well. In an extreme risk-off environment, gold stocks may go lower, but those may be bargains. Some of those companies are going to make enormously good margins with gold at the current price levels and oil falling. And now with the Saudi news, I probably have to do a separate live stream show now on the Saudi news. You know, in only a couple days, the Saudis have went from a combined 1.5 million barrels per day cut to now reversing course a 180 to trying to increase oil production because the Saudis want to put the kill shot, the executioner's axe on shale oil companies, which are much higher cost in reality than the Saudis' production cost. Not the $35 a barrel. Excuse me, my voice is going now. That's why I need to shut it down. Not the $35 per barrel profitability that Peter Zeihan is claiming for shale. Shale is subsidized. I got in a long Twitter argument a couple weeks or a month ago, something like that, with Peter Zeihan. Hey, he gets all these high-paying consulting gigs. I just work in reality. So no, I would not be long any oil stocks right now. I think the volatility in oil is going to be immense. If the Saudis are going to increase production, the Saudis are willing to let oil prices go down maybe even into the low 30s, maybe even below 30 temporarily. The Saudis are going for the kill shot here. Okay, everyone, thank you for listening to this live stream show. And all the articles discussed will be in the information and description section. Again, thank you very much to my Patreon account contributors. There's over 400 now. It's incredible. The growth that's happened in the last couple months is unbelievable. It's a combination of my hard work and luck. I honestly didn't think that this would happen anytime soon. I thought it would take a year or 2 years. And it's just increasing unbelievably fast. People signing up for $5 a month. And I'm working very, very hard, sometimes many sleepless nights, to get out audio podcasts, articles covering a lot of different perspectives. There's stuff in there that when I speak to hedge fund managers about a certain company, they don't even know, and they're impressed that I bring it up to them. And I have a lot of hedge fund contacts I've met through Twitter now. Okay, everyone, thank you very much for listening, and thank you very much to people who chip in. I know times are tough, and things may get a lot worse. So if you guys invest with me and stick with me, the content's going to keep on coming, and it's going to be some of the best research, information, analysis, and financial education you can find anywhere.